who will be here to give us his expert legal opinion, or sorry, I shouldn't say legal opinion, should I? Legal view on the various different pieces around employee share schemes. Now, I think this is an area that a lot of our clients tend to look at, and is particularly popular at the moment. We all hear in the press about staff retention being key, and the kind of the skill shortage. So actually keeping your key people on board, helping drive your business forward, has probably never been more important. So from that point of view, we thought it was a very timely subject to cover. So this morning we will run through sort of the key points which I think would affect you and the business. So as it's involving legal speak as well, we have a standard disclaimer. So obviously, if you do want to look at anything in more detail, we're just giving you the high level here. So please do come back to us, and we're happy to help. So what we'll cover this morning, what are the key things to think about when looking at employee incentivization and share schemes? Actually, do you give them shares, or do you give them share options? Do you want someone to be a shareholder in your business now? Or do you want them to just have the promise that they can have some shares in the future? So we'll cover the kind of pros and cons of that. And also not forgetting that shares might not be for everybody. So actually, should you just pay them a cash bonus, depending on the individual involved, and also your appetite for potentially diluting a shareholding within your business. So those are kind of the high level areas that we'll look at. And within those, we have things like what actually is a share scheme. Now, people often talk about it, but really we'll give you more of a lowdown on what it is, why you would use a share scheme, so what we see the key pros and cons are, and how you would use it, the tax issues, which I'll cover, which is always one of the main hurdles. Also the legal issues, which I think Mark will shadow if I try and cover, and also the different ones available. So there's not a one size fits all, and there are various different things that we can do with that. And then also cover something that's quite a hot topic at the moment, being an employee share ownership trust, which is something a bit different, but also something you may have heard about in terms of employee motivation. And I know there's been a couple of instances in the local press recently where businesses have followed that model. So we thought it would be worth touching on. So during the presentation, if you've got any questions, obviously feel free to put those in the box that you should have, or should be able to access at the bottom of the Zoom screen, and we'll cover those at the end. As we run through, we will just move between Mark and myself, covering the best, whether it's commercial or tax and legal angles, and also it saves you listening to one of us for too long. So without further ado, we will get moving.
Thanks, Chris. So what is a share scheme? There are various different types, and we'll come on to those as we go through the session. But essentially, in a very basic level, it is just a means of using shares to incentivize employees and possibly key personnel, depending on the sort of scheme that you use. This could be by issuing shares now, simply by issuing ordinary shares, or perhaps utilising a special class of shares, such as growth shares, or it could be using an option for the individual to buy shares at a point in the future through a share option scheme, such as an enterprise management incentive, or EMI for short, or an unapproved share option scheme. And as I say, we'll come on to those and go through what they are in a bit more detail as we go through the session. Before anyone gets too far into the planning of a share scheme, though, it is always worth just pausing and considering who you want to benefit from it, why, and what the quantum is. All too often, I think people can get a bit carried away with the tax benefits of certain schemes, and that therefore it must be the best, and lose sight of actually what was the main commercial driver for this, which was to try and incentivize employees and make sure that they're aligned with the interests of the shareholders for the benefit of everybody. To give you an example of that, a common scheme we see is an exit only scheme. So effectively, the right to acquire shares is contingent on an exit, such as a share sale happening. And that can be a great incentive if that is the direction which the company is heading. But actually, if the likelihood of a sale arising is fairly slim, then obviously, and it may seem obvious, but an ex-only scheme is probably going to be a relatively limited incentive to those involved. So it's surprising the number of times that actually the tax does start to become the driving force at the cost of the incentive. And it's always worth just coming back and thinking, actually, is this going to actually achieve the commercial outcome that we set at the outset? Following on nicely from that is not to forget cash. Everybody understands cash. Cash is king, as Chris, I'm sure, will remind me on a number of occasions. And sometimes actually just using a cash bonus might well just achieve the incentive that's needed. It's something everyone's familiar with, and it shouldn't be overlooked. It might not be quite as tax efficient as some of the schemes we come on to, but if it achieves that incentive that you're looking for, it might be the best solution, even if it's not the most tax efficient. And then just finally, I think the other big point to just mention at this early stage is that inevitably, when you're doing a share scheme, you are allowing people potentially to join your shareholding club. And you should take that very seriously and make sure you get the right advice. The last thing that you want to do is to implement an incentive which has great benefits for everybody, but then is undone because actually the scheme wasn't properly implemented. Things don't quite work out how everyone expected, and suddenly you've got a problem within your shareholding level, which is where your key ownership of the business sits. So it is really important to make sure that the proper advice is taken, and everyone thinks carefully about how it will work going forward, what happens if things don't work out as we would expect. And we'll cover some of those issues as we go through the session as well in a bit more detail. The other part of that is also just being mindful of the impact issuing shares, if that is the route you're going to take, would have on dilution. And it's certainly always a very good idea at the outset and to make sure that everyone is clear, to ensure that you do have a good spreadsheet that sets out the current shareholdings and then the impact that full dilution, should these schemes be implemented, will have on each of the shareholders and their shareholding proportions, so that everyone understands and has their expectation managed as to quite what will the final outcome be once the share scheme has been implemented.
I know, Mark, you mentioned about making sure that at the start that you do get the advice, and actually you look at the kind of the paperwork behind it. And I know you'll cover the legal bits in a bit, but I think between us, we could easily recollect the number of times where a client has come to us and said, oh, I've always been promised this number of shares at a certain point in time, but they haven't got anything necessarily in writing, or they didn't get that implemented at the time. And therefore, when you come later to try and actually put those things in place, it's much harder to do it retrospectively than it is to actually do it at the time that kind of handshake agreement is made, I would say.
Absolutely, and there's two common issues that come out of that. Is one which you'll come on to on the tax side is the issues that valuation can cause if time is lost sort of between the promise and actually implementing any scheme, but also if you haven't properly thought through quite what that promise of certain shares will have on those shareholdings, again, you can start to head into difficulties as to actually whether or not the promises that made can be delivered, because the existing shareholdings, it skews things in a way that perhaps people hadn't anticipated. So it is always really important to just pause for breath at the outset and properly think through how the whole piece will impact on the company as a whole.
So I know Mark mentioned not to let the tax overwhelm things, but it does tend to be a very important element of any share planning that you're looking to do. The main concept really is that you are giving something of value to an individual. So as you can imagine, as with everything, the revenue get very keen when you're trying to reward people for any work that they have done or they may want to do. So the main principle, whether you're looking at an actual shareholder change now, or putting in place an option scheme for somebody to acquire shares later down the line, is that the establishment of something known as the market value. So actually, what is the value of the award that you are giving to that individual? So we need to calculate that to start with, so that we can then look to assess what the tax is off the back of that. You do have a couple of choices with share transactions, whether the person that you're offering the shares to has to pay for the shares or not. So, for example, say their shareholding that they're being promised is worth £100,000. You have the choice when setting up the scheme whether they have to pay either you or the company that £100,000 at the start, at the time that they acquire their shares, sorry, or whether they don't pay that £100,000 and you simply gift them that amount of value. So if you do the gifting route, they will pay tax on the value that they have received. If they have to pay full market value for their shares, they don't have to pay any tax at that point, but they have had to part with, say, £100,000. So it's very important, again, to have that expectation set at the outset of how does everyone think it will work, who's got to actually part with money. And if they don't pay the full market value, you can do a balance. So if that holding was worth £100,000, they can only go and raise 40 or 50, then they'd have tax to pay on the remainder. So it's also important to know that that tax is income tax. So that will be charged at their usual kind of marginal rate, which I'd suggest in the majority of share deals is probably 40% upwards. So again, it's really important, as you can see, if you're going to be paying 40% on whatever you receive, to establish that market value, and also how much does the recipient actually have to part with the cash. So once they've acquired the shares, you do need to then remember that at some point they will potentially sell the shares, and then there'll be capital gains tax to come on that sale. Now, those are the key principles. How they line up against the different options of the share schemes we'll run through as things go on, but that's kind of the main things to get your head around when considering what scheme is right for you.
In terms of the main legal concepts, the first question is to ask is how will the scheme be structured? Is this going to be a right to acquire shares now, or is it going to be a right to acquire shares at some point in the future? As that will largely drive the paperwork that is needed to document it. If you're looking at just issuing shares now, then the obvious documents you're going to need, or key documents, are revised articles of association for the company, and also usually you would have a shareholders agreement that sits alongside it. The articles being a public document available at Companies House, and the shareholders agreement being a private document between the shareholders. And you can obviously see why certain things would go in one and not the other. If the scheme is going to be structured as a right to acquire shares in the future, then you'd still usually need to have revised shareholder agreement articles, but on top of that, you'd also need the scheme documentation itself. So whether that be an option or however the scheme is being structured, that would be another layer of paperwork that's required. In terms of the shares themselves, one important thing to look at is the rights that should attach to those shares. The main rights that people tend to look at in this regard are rights around capital, rights around income, and rights around voting. The right approach to how they are structured is usually driven by tax and commercial discussions, but the sorts of things that you can look to do are around the capital. So when we talk about capital, we essentially usually mean what will happen if there is a sale of the company, and there are different ways that these can be structured that we'll come on to. In terms of income, this is your dividend rights. Should there be any dividend rights at all? Do all shareholders share equally if there's any dividends? Perhaps there may be some preferential rights in certain circumstances. So again, that's an aspect that just needs to be set out and determined as part of the process. And then with voting, it tends to be more binary. Will they have voting rights or won't they? But there are sort of some in-between steps that also apply. And as I say, those sorts of conversations tend to be more driven by the tax and the commercial. The legals, usually you've got a reasonable amount of flexibility to just make them work depending on what has been agreed as part of that process. Another aspect to the shares is what restrictions and protections apply to them. And this is particularly important because you are extending that shareholding club, and you want to make sure that if things go wrong, or once the scheme is implemented, that there isn't a negative impact on the shareholdings as a result of using shares to incentivize employees. So the sorts of things that you would typically look at are what would happen on transferring shares. Should there be transfers allowed at all? Should they first be offered to shareholders? Those are the sorts of things that we'd expect to be covered off in the Articles of Association. You'd also look at things like, are there any circumstances where there should be a forced sale of share? Perhaps if the employee leaves employment, the employee should then be required to offer up their shares to the other shareholders. You can also, as part of that process, deal with the price for those shares depending on the circumstances of the departure. This is often referred to as good leaver or bad leaver if you hear those phrases used, but ultimately it's where you've got a trigger that says, okay, you've left employment, you now need to offer up your shares for sale. What is the price of that? Well, that price may depend on the circumstances of your departure. Other areas would often get covered as well are what would happen if there is a sale. It's commonly referred to as a drag-along right, but this allows the majority to drag the minority where there is a sale for the entire issued share capital of the company. The logic being that what you don't want is, a 5% shareholder perhaps being able to effectively frustrate a sale because they're refusing to sell to the buyer. So you would normally expect there to be a drag-along right that will allow and ensure that the majority can take that minority shareholder with them if they choose to proceed with a sale. And other things that are often covered off are non-competes. They should be already covered in the employee's employment contract, but it's always worth providing for them in the shareholders agreement as another layer of protection. And also shareholder reserve matters, particularly if as part of the scheme, some of the existing shareholders are perhaps taking a less involved role in the business going forward. Shareholder reserve matters allow you to set out a number of commercial actions and steps that effectively can't be taken without the requisite consent of the relevant number of shareholders. So again, it's just another way of putting some checks and balances in to make sure that by implementing the scheme, you're not undermining the effectiveness of how the shareholders have operated to date. So, as I say, the three key documents tend to be the shareholders agreement articles and the scheme document themselves, but also don't forget the employment contracts. Obviously, there are sensitivities from an employment law perspective around any changes that are made to employment contracts, but particularly if the scheme involves elevating an employee, perhaps they're becoming a director as part of this process or taking a more involved or more senior role within the business, then it'd be well worth making sure that the employment contracts are looked at to make sure that they are still appropriate for the role that is now being undertaken.
Cool. Thanks, Mark. Yeah, and it's so important just to get that background right, isn't it, at the off, to cover any, I suppose, disputes down the line, which as normal when you're going into a shareholding with somebody that it's all good at the start, but if something does go wrong, what do you do?
That's it, and this is the key ownership. The shares are the ownership of the business, so it's not something you want to do lightly. You want to make sure you've got all the sensible checks and balances that you should have.
So I think the base starting point really is or the easiest thing that you can do is simply pass some shares to an employee now. Now, that's the simplest way of doing it. It might be the most or least tax efficient way, depending on what your particular position is. So I think the key concept is actually what's the value of the item that you're passing. So what you will see, depending on how the business moves forwards, is that someone who might undertake a due diligence exercise on the business will look for some evidence that you've actually obtained a valuation and you can substantiate the tax treatment that's gone along with these shares. Because if you think that the potential downside for somebody is 40% of what you're giving them, suddenly the revenue also can get very interested. So to have a valuation to hand that if the revenue ever look at the transaction, you can show them that actually we did think about this at the time, the valuation was done, this is how we arrived at the value, this is how we've arrived at what we've taxed. That's a much stronger position than having to try and do that retrospectively. and we also know from experience that excuse me, the revenue tend to look more favourably on things if you have all your paperwork done at the time, rather than kind of trying to retrospectively put it in place. They see that you've gone through a thought process rather than actually you've done something and you're worrying about the consequences afterwards. So step one, definitely get a valuation on the shares that you're making available, be that a simple share transfer or an option arrangement. We'll come to those in a bit more detail. So if we said the company's worth £1 million, we want to make 10% available to an employee or a group of employees. Now, obviously, it doesn't take a genius to work out that 10% is therefore £100,000. But when looking at the values around shares, the revenue do have a discount table / matrix that says that if you're giving away a non-controlling interest in your business, then that's going to have value implications in terms of those shares not being valued in a similar way on a straight line basis. So in this example, we'd expect actually that £100,000 worth of shares being the 10% to actually, for tax purposes, be looking at more like 20 to 30k. So at that point, at least it becomes a bit more palatable for the individual that they would only be suffering tax on the 20 or 30k rather than the full 100,000. Now, what that does do as well is it almost gives the employee receiving the shares an inherent uplift in what they've received. So if you are, excuse me, going to sell the business later down the line, they will likely receive that 10% on a straight line basis of whatever the sales price is. However, they have only had to buy in or pay in or be taxed on 20 or 30k on the acquisition of those shares. So there is an uplift for them, which is kind of one of the incentives to sort of think about really when explaining a share scheme. And I think it's good to know that if you are looking at a share scheme with employees, then actually one of the good things is that probably myself, Mark, is the same. We're happy to come and sit down and run through with those recipients of the shares, actually, what does it mean for them? Because one of the key questions that we get is, oh, am I going to have to pay tax on this? You know, when am I going to have to pay it? All of those kind of things. But if you actually explain to people that the process, it goes down a lot better, because actually you're trying to do something that's in many cases very favourable and advantageous for that person, but perhaps they don't always understand the benefits. So it's worth making sure that your communication of the message of what you're trying to give over is well conveyed to the employee so they really understand what the benefit is they're receiving. And subsequently, that incoming shareholder could be entitled to entrepreneur's relief. They probably work within the business. As long as you give them more than their 5% as it is at the moment, for more than 2 years up to the point of sale, then they could be paying 10% on the money that they receive when they sell the business. So again, a good add-on / benefit. And if you do simply pass in shares, simply pass your shares to an employee now as kind of straight away. You do, of course, have a new shareholder and all the pros and cons that come with having another person, as Mark said, join the shareholder club, or sat around the table when you have to make those decisions. So it's worth thinking carefully of actually, do you want a shareholder, or are you looking to just retain somebody, and do we need to then look at options or cash balances?
That's exactly right, Chris. And so, as I've just said on the previous slide, you know, if you're going to issue shares up front to a shareholder, you know, make sure that you've got a well-drafted set of shareholders agreement and articles of association. In terms of the more commercial aspects, I suppose what you've got here with us issuing ordinary shares is the fact that you are now providing the employee with a direct interest in the shareholder returns. So you can see where the incentive starts to form here, that employee now is incentivized to grow the value of the shares, which in turn will benefit the majority shareholders. So you can see the obvious benefits that this sort of scheme could produce. But on the downside, you've got the tax risk that Chris has mentioned, and also the potential upfront cost if market value is going to be paid, and that is a reasonably significant number. You're then asking an employee to put their hand in their pocket to pay for something that is supposed to be a benefit to them, and for many that might be quite off-putting. They may not be prepared to take that sort of risk, so it's always worth keeping that in mind. And going back to that initial question, is this the incentive that we're looking to put in place? That then probably just moves us neatly on to the next slide, which is on growth and flowering shares. So the principles are very, very similar to the issuing of shares up front as ordinary shares. The growth shares will be issued usually at the outset. Don't have to be, but that's often the way that they're structured. And so you have a lot of the same thought processes as you would do with just issuing ordinary shares on day one. It's important to get a valuation, as Chris has said, to make sure that you've got a robust position and defendable position as you can, should HMRC or perhaps a purchaser in the future look to query whether or not that valuation was accurate. But essentially, what you have with growth shares is a special class of share. And by creating this special class of share, you're therefore trying to produce a lower value for those shares when they're issued. The idea being that you allow the holder to benefit from future growth in the value of the company, as opposed to all the value that has been generated up until the point of issue. So if we use a similar example to the one that Chris used, you've got a company that's worth 1 million perhaps, and you're looking to give them 10% to an employee. What we would look to do with a growth share scheme is amend the Articles of Association so that the existing shareholders would share in the capital. So it's coming back to those capital rights we talked about earlier. They would share in the capital on a sale of the company up to the first 1 million, and then any proceeds over and above that would be split between all shareholders, including the growth shareholder. So then in effect, you're incentivizing that growth shareholder, that employee who holds those shares, to drive the business forward and to achieve that growth, because that is where they will start to see returns from those shareholdings. As with the issue of ordinary shares on day one, the employee would need to pay what the eventual value of those shares is, and if they don't, they'd have to pay the tax on the difference. But the benefit with the growth value of the growth shares is that hopefully that will be a relatively low value compared to the market value of an ordinary share, which would have to be valued by reference to the value up to the point the share was issued. So in terms of the advantages of a growth share scheme, particularly over just issuing ordinary shares, is that you've got that low market value, which should therefore mean a low upfront cost to the employee. They still have that direct interest in returns, and in fact, because it is a growth share scheme, actually there's a greater incentive, because it's only in that future growth that the shareholder benefit, the employee benefits, and therefore there is that added incentive not to just rest on the laurels of the existing value of the business. And it can also be used alongside an EMI scheme, so you don't necessarily have to issue on day one. It could be coupled up with an option scheme and used and to get the benefits that we'll come on to when we talk about the option schemes. Some of the disadvantages, just to touch upon, is that growth schemes do need some careful design, to make sure that they do all achieve all the tax benefits that we would like them to, and that low valuation, and so they can be quite expensive to implement. Not extortionately so, but there is a degree of expertise needed into their preparation. They also don't necessarily apply to all companies. Most private companies can have separate classes of shares, which is what you will need to be able to create the growth element that makes the scheme work. But if you're looking at this from the eyes of a public quoted company in the UK, then there are restrictions on the complexities that can be put into their share structure, and so growth shares are probably unlikely to be an option that's available to them. And then, of course, the other big point is that going back to that initial question, is this an incentive? Well, for this to be an incentive, there has to be a reasonable prospect of the company continuing to grow over the coming years. Otherwise, you're just going to end up with a frustrated employee who's had the promise of sharing in some equity, but actually the reality is it will have very, very little value. So again, always come back to that initial question: is this going to be an incentive? A similar scheme to the growth share schemes is what's referred to as a hurdle share. Very, very, very similar concept. The only real difference is that whereas with a growth share scheme, you tend to set the growth amount at the existing value of the company at the time the share is issued. With a hurdle, you tend to go with a slightly higher valuation, the idea being that the employee won't actually share in any of the benefit until that growth, that hurdle amount has been reached. So if we use a similar example to the one we've just touched upon, if the company is worth $1 million today, the hurdle will be set at 1.2 million, so that when you amend the articles, the existing shareholders would share in the value up to 1.2 million on sale, and it would only be in the amount over and above that the hurdle shareholders would be able to share in it alongside the other shareholders. But apart from that, it is a very similar scheme to the growth share schemes. It is really just that hurdle element that is the difference there.
And I think in really explicit terms, the low valuation just comes from the fact that if the company is worth £1 million today and we ring fence that £1 million for the existing shareholders already, then how much would someone be prepared to pay to come in and buy those second class of shares for? Not a great deal, because as of today, they've just got that hope value rather than any actual value. So that's the reason we can sort of get that depressed valuation, really. So Marcus very kindly covered the kind of the concepts around how we would give shares immediately. The other side of things is actually how do we do it if we just want to give people the promise or an option to buy shares in the future, which is essentially a piece of paper that is a promise that they can acquire shares at a later date, at a set specific time or performance criteria or long service or any kind of circumstance that you want to put around them, really. Now, really there are two, as I've put here, there are two types of scheme. One is HMRC approved, and also you just need to be mindful that when we say schemes, we're not talking about Jimmy Carr kind of front page of the newspaper type schemes. The revenue themselves call them schemes, and a non-approved revenue scheme. So fairly simple on that front, either it's HMRC approved or not. Now, the main differential between whether it's HMRC approved or not is just the tax treatment. It's not whether you can do it, it's not whether HMRC will look more or less favourably on it or you or the shareholder. It's just that the HMRC approved ones are designed with a specific purpose in mind, and we'll just chat through those shortly. But they then come with conditions that you have to meet from the revenues perspective, but B, it just comes with that HMRC approved tag. So nothing kind of sinister about approved or unapproved, but that's just how they're categorized. So if you're looking at the HMRC approved routes, you have a enterprise management incentive being the EMI. So that's typically aimed at trading businesses who are looking to go on growth, and there are some conditions around the people that you can involve in that they have to be employees, they have to be working a specific amount of time within the business, etc. So that's a very popular one that we see amongst our clients, and we'll definitely talk through that in more detail shortly. There's a company share ownership plan, so a CSOP, which tends to be, if you can't use an EMI, we might look at that one instead because the rules are a little bit less stringent than they are on an EMI. And save as you earn or matching shares, and that's if you're getting into a bit more of the big company, many employees wishing to give out shares every month or two to employees. So someone like Tesco, for example, I think uses a matching or save as you earn scheme. So we don't really see those in our client work, but they are there. So just so they're there. And anything else, any other kind of way that you want to structure options is just unapproved. Can still be done. We can do whatever we like, but it's just not HMRC approved. So yeah, those are the various different options. Not sure if you've got something to add on those, Mark.
Yeah, so just to recap on the legal aspects of that, the share option, it's essentially just a contractual right to acquire shares at a point in the future, in legal terms. And depending on the scheme that you use, largely whether or not it's approved or unapproved, will depend on the flexibility. In all cases, there's a reasonable amount of flexibility in how they're structured commercially, but certainly with the unapproved ones, there is greater flexibility because there are just no tax constraints with how they are put into place. There are two sort of common ways of structuring the option itself from a legal perspective. The first is what's often referred to as time and performance. So that would be, essentially that the option, the right to acquire those shares would only vest after 5 years. So that's encouraging that employee to remain an employee during that time. And you'd often then couple that with some performance criteria as well to make sure that they've not only remained in employment, but they've also actually been doing a good job. And the important thing with those performance criteria is that they are clear, they're easy to measure, and that they serve the purpose of being the appropriate incentive. You don't want them to be too aggressive that they're just the employee loses interest, but equally you want them to encourage that employee to push themselves and to deliver value to the shareholders. So they need to be suitably challenging to achieve that. The other common structure that you see is what's referred to exit as exit only, as I touched on earlier. And essentially, this is where the option and the right to acquire those shares only becomes exercisable at the point that there is an exit event, such as a sale of the company. This is probably the most common structure that we see, and is nice and clean because it basically means that option holder only ever becomes a shareholder a moment in time before the sale. So you've got less risk for them because they will be able to judge whether or not they want to put their hand in their pocket to buy those shares based on the price that's being promised by the buyer. And it also means less risk for the shareholders because they don't have to worry too much about the impact it has on the shareholding relationships during the lifetime of the option. It's just a question really of the dilution that everyone should be aware of that will arise at the point of sale when that option is exercised. As with just issuing shares, you should be looking at getting your shareholders agreement and articles of association up to date and considering those share rights, but also making sure that the scheme paperwork is properly drafted. And I think some of the extra nuances that can be dealt with, as well as the triggers for when those options get exercised, is what will happen on a lapse. And that option paperwork allows you to deal with what would happen in the event that the employee leaves their employment. Usually they would just lapse, perhaps with a discretion for the company, but again, that's something that's important to cover off. And also, as a practical point, you also just want to make sure that any scheme paperwork lapses if the option is not exercised on an exit event, because you wouldn't want those options hanging around and causing issues, possibly even frustrating the deal altogether, should the buyer not be able to acquire the entire issued share capital.
Thanks, Mark. So if we start with just lost the ability. There we go. If we start with how you could do an unapproved scheme. So the employee obtains an option to buy some shares in the future at whatever performance criteria, circumstances you would like to invoke on them. It could be just that they're still employed in 3 years' time, or 2 months' time, or whenever you choose, or it could be that turnover has reached X. So you get to set those targets that you would like them to meet. The employee is then taxed on income tax, or as we talked earlier, pay for the market value for their shares at the time that they can actually kind of cash in their option, give you the piece of paper which says, I'd like to exercise my option and buy my shares now. So if that's 3 years down the line, they're effectively taking the chance that they will be able to buy in whatever the company is worth in 3 years. Now, all things being equal, you would hope that that value is increased, but at that point, that is actually to their detriment, in that they've got to find some more money to buy in, or they have to pay tax on a bit of a difference. So we tend not to see so many unapproved schemes, but they do come into play if you can't meet the criteria for EMI or the CSOP schemes in terms of the business is too big, or the existing ownership of the businesses doesn't quite match the revenue rules for what we'd need for an EMI. So there are various circumstances where these would come into play, but we tend not to see them as first choice for clients. But I think it's worth noting with all of the share transactions, also you do have the annual reporting requirements that the revenue want to know that things have happened and a relevant tax has been paid. And now, if you go back 3 or 4 years, they probably took a very light touch to those reporting requirements. Whereas as the purse strings have been tightened, suddenly we're seeing them invoking penalties for reporting which is a day late or hasn't happened. And I've had a case recently where a client sold their business. Thankfully, we weren't doing the share transaction reporting for them, but nothing had been done for the last kind of 7 or 8 years. And then the buyer was obviously very concerned about potential penalties, so we had to rectify that situation. So always advisable to just make sure you're up to date, or you ask us to keep you up to date on the various reporting requirements as well. The other key thing is the capital gains tax of an unapproved scheme. So as soon as the employee sells their shares, they will have capital gains tax to pay versus the value that they acquired the shares for. And that will be, depending on their marginal rate, I would suggest that will probably be at 20%. So no special tax breaks or circumstances around an unapproved scheme, but you do have complete flexibility on the type of business that can do it, the type of employees who can take part, and the criteria that you set around it. So you can do what you like, but you have to pay for the privilege. Is kind of the summary on an unapproved scheme, really. I think Mark will just run you through. Well, both of us will run you through some of the EMI bits.
Yeah, thanks, Chris. So EMI is the one perhaps most people talk about when it comes to share options schemes, and it's certainly the most common one we see. It is aimed at incentivizing key people to remain in the business, which obviously has huge commercial appeal, as well as the tax benefits that Chris will cover off in relation to EMI shortly. You've got flexibility to pick whoever you want within the business. As long as they are employees, they do need to be eligible employees to qualify, but it doesn't have to be all of the employees. You can choose whichever key employees, if you want to, that should benefit from the scheme. And you've also got the flexibility to set the commercial conditions that applies is implemented. The value for the tax or the purchase purposes is the value at the day that the option is granted and when the shares are valued, and not when the option is exercised. And as I say, Chris will go into this in a bit more detail, but this is perhaps the greatest benefit of the EMI schemes, in that it allows you to draw that line in the sand and to crystallize the value at the point that the option is granted and the company has been valued, and not at a later date when the option itself is actually exercised, which could be some years down the line, and at the point when the company hopefully will be considered more valuable than the point at which the option has been granted. And it's probably this element of it that perhaps makes these EMI schemes so attractive. As with all schemes, the structure, you've got that choice between time and performance and exit only, or even wider flexibility if you choose. But exit only is perhaps the one we see most common, because it is the cleanest approach. It allows you to grant that option. The employee doesn't have any financial commitment at that stage. They've got that right to acquire those shares on an exit occurring, at which point they can make a decision as to whether or not they wish to exercise it. Basically, is the buyer prepared to pay more than the cost of the shares to buy them? So there's very little financial risk for the employee, and it limits the impact on the shareholdings, because that employee will only hold their shares for a moment in time. The thing, of course, though, always to come back to that initial question is this an incentive? It's not going to work as an exit only if the company actually is unlikely to be sold in the near future, and certainly if it's not going to be sold sort of the next 3 to 5 years, then that incentive element isn't going to be there. So we either need to look at perhaps a time and performance scheme, which has the added risk that you've then got that individual coming into the shareholding club at a time when the company and the shareholders are still involved, and all of the things that brings with it in terms of the checks and balances and the protections that you need. It's also worth mentioning that there is all of the annual reporting requirements, in fact, probably more so with EMI, both at the time that the scheme is granted and through the lifetime of the option. And again, it's very important to get those right, particularly because failure to provide some of that information, particularly failure to notify the revenue of the scheme when it is implemented, will cause potentially the lapse of the scheme altogether, or not the lapse of the scheme, but certainly the tax benefits. So it is really important to take advice when implementing an EMI scheme. There's a lot of common mistakes made. A lot of people assume that every company will qualify for EMI. They don't. And because of those strict rules that apply in terms of how the scheme is implemented from a statutory perspective, whilst you've still got reasonable flexibility to create the commercial arrangements that you have in terms of how the option works, in the same way that you do with an unapproved option, you do need to make sure that all of the statutory requirements are met and complied with. Otherwise, it will potentially fail to meet the tax advantage status. And so it is really important to make sure that advice is taken from the relevant professionals to ensure that these schemes are implemented properly. To just give a bit of a comparison between unapproved and the EMI schemes, the commercial concept is very much the same. It's that right to acquire the shares at a point in the future. The biggest difference is the tax advantage that you get with an EMI status. Now, that does come with the fact that you've got to comply with all the strict rules, which means that they tend to be a little bit more expensive to implement, and a degree of more caution is needed in how that is done to make sure that the tax benefits are achieved. But usually that's more than outweighed by the tax benefits. So hence why we tend to see EMI schemes as the most common type of scheme that we implement.
Yeah, thanks, Mark. And I think just to kind of reiterate the tax point, in that on the unapproved scheme, the income tax is set when the individual acquires their share. On the EMI situation, the tax point is set at the valuation when the option is given. So whilst they don't have to pay that tax, then the kind of the taxable value is frozen at that point. So if the company does increase in value before any kind of sale or any kind of event that means they can exercise their shares, then the tax position is frozen at today. So more of an incentive for them to help grow the business, because the item that they receive in the future will be ultimately more valuable, but without any further tax burden. So a very popular scheme amongst our clients, and probably aimed at key management. So tend to see 2 or 3 people, perhaps maybe 5, in this kind of scheme. But I have seen as many. I did have a client who was looking at kind of 20 plus, because they really wanted to get the whole team on board and get them involved. So definitely a favourite amongst our clients, and as long as you can comply with the tax rules, which aren't too stringent, then it's kind of the place to be looking, really, I think, for an option scheme. So very popular. And I suppose the last thing to just cover off really is the employee share ownership trust. Now, this tends to be for businesses who don't necessarily have any form of planned exit. So there's no one that they can think of who will come along and acquire them, or there's no succession within the business. For example, if the management team can't afford to do a management buyout of some kind. So if essentially the shares of the outgoing shareholder get transferred to a trust. Now that trust, which crystallizes a capital gain for that outgoing shareholder, that trust then holds all of the shares for all employees in the long term. So you don't necessarily take on a new group of share owners or shareholders. Everyone within the business becomes that shareholder. So it's a very kind of niche / targeted approach, and as I've put here, it needs a cultural shift and a long-term project in terms of, if you think about your business, would you envisage all of your employees being ready to be shareholders in your business? Because that's what this effectively comes down to. Everyone needs to have that mindset, everyone needs to have that buy-in. So it's, with the other plans that we've looked at, you can kind of implement those in 2 or 3 months maybe. Whereas for this, talking to someone recently who I think is quite an expert on these, they're recommending kind of a 2 to 3 year lead time of actually getting that culture ingrained in your business, getting people right within the business, also getting them to trust the management team who are going to be taking on the running of the business, because that new management team is running the business on behalf of everybody. So there's a whole kind of raft of things here why you can't kind of rush a share ownership trust through. And again, we don't see them very often because purely our clients' mindset tends to be they'd like to incentivize a few key people, but actually, do they want to give up all of their shares and have kind of no control over the business in the future? So just thought I'd touch on it. It's kind of a hot topic at the moment. The government made some changes to some rules a few years ago to enable this to happen more. I think they saw the John Lewis model, they liked it, they saw what it did for the people there, and kind of opened that door to other smaller businesses. So that is there, it does exist, and happy to talk to anyone about it, but it doesn't really come with shares being ending in employees' hands. They kind of normally get stuck in the trust, and the trust kind of owns them infinitum for the benefit of anyone who is an employee of the business. So a long-term view, and also one that if you're looking at an exit or you want to incentivize certain individuals to get value out of the business at some point, probably isn't for you. But just thought we'd touch on it as it's there, really. Yeah, which leads us to non-share items, really.
Yeah, so whilst strictly speaking, these aren't share incentives, I think it's important just to very quickly cover off cash incentives. The most obvious being the cash bonus. It's something that everyone's familiar with. It might not benefit from the tax advantages and will just be taxed as income. But you can couple a cash bonus with performance criteria to make them a much longer term incentive. And if that cash bonus is valued by the employee, then sometimes commercially it might be the best option, even if it's not the most tax efficient. The phantom share option is a variation of that, really. It is just a glorified cash bonus. It's a cash award linked to the value of the company's shares. It's often used by private or overseas companies where actual share options are not appropriate. But it is and can be made to look and feel very much like a share option. You have an exercise price based on the share's value at the point that it's granted, and the whole purpose is that the cash bonus element of it is then calculated by the increase in value of those shares. So you are aligning aligning employees directly with the interests of shareholders. It's just that you don't touch that shareholding. They never have a right to acquire shares, and they simply get a cash bonus by reference to any increase in value. So just wanted to quickly touch upon those because they're often overlooked, but are good ways that can be used, perhaps not as tax efficient, but still are worth keeping in mind, because for the right business, the right employer and the right client, they can still be a good way of incentivizing employees.
Thanks, Mark. I think we just put together some tips, didn't we, as a summary of what we've talked about, really. And yeah, as we said at the start, be careful not to let the tax override everything, but it's going to be the most costly element of whatever you do in terms of share incentives. So make sure that the tax angle doesn't sway your commercials, because as Mark has alluded to, if you get things which are just not appealing to individuals, irrespective of how tax efficient it is, that it's not going to work for incentivizing and motivating them. So I think always just keep an eye on that.
Exactly, and always consider who and why you're incentivizing, and whether this is a short-term goal or a long-term goal, because that will drive what is the right outcome for you. And ensuring that any incentive you use is truly an incentive. That's got to be the it's the commercial driver, and whilst you want to do that as tax efficiently as possible, you don't want to let the tax tail start to wag the dog.
Yeah, and I think that's where the EMI comes in nicely. It works commercially, it works tax efficiently, but there are just qualification criteria. So feel free to pick up the phone to me, to Mark. We can sort of talk you through those. Just make sure you qualify, really.
Yeah, and don't forget the other options. To say, all too often people come to us that they want an EMI scheme, but without necessarily thinking about in any great detail why. It's start from the basics. Make sure that what you're doing is the right thing for you, the business, and the employee, and ultimately just don't leave it too late. The later in the day, the later the process, the less chances you've got in terms of your options, particularly from a tax perspective. So the sooner you get talking to people, talking to the right professionals about these things and getting them implemented, the more chance you have of being able to find a tax efficient way of achieving your commercial goals.
Yeah, because I think the overriding principle really is, can we get or trying to get the biggest gap possible between whatever the company is valued now, whenever you pass those shares to somebody, or give them an option, if it's an EMI, for example, whatever the value is now versus what the value is when you sell. So the bigger that gap can be as possible gives them the best tax advantage for that value uplift as it happens. So yeah, if you're act early, and let's get everything done. As I said, it probably takes 2 to 3 months, because we have to go to HMRC for approval on something like an EMI, and as we know, the revenue don't always reply quite so quickly. I think the current turnaround times, they were estimating 3 to 4 weeks pre-COVID. Now it's 4 to 6 if you're lucky. So there are a great deal of moments where you think nothing's happening, but actually we are just waiting for HMRC to come back and all those kind of things. So yeah, give yourself a little bit of time, and also have a good chat through with the employee, that they understand what they're being given and how it can benefit them. And again, me and Mark are more than happy, I'm sure, to have a sit down with you. And I know I've done that before for clients, where just going to talk to the people receiving the shares, explaining what it's about, how that might impact them, and any questions they have can be reassuring. So that option's always there as well. But otherwise, I think, I'm not sure there are any questions, but if anyone has questions, obviously feel free to put them forward. But otherwise, we've obviously just explained it so well, Mark, that no one's got any questions. But if you do have any points, obviously feel free to get in touch with us or Trethowans. And yeah, they'll point you in the direction of me and Mark. So otherwise, I think just thank you for your time, really.
Thanks, everyone.
And yeah, thank you for joining, Mark.
Thank you, Chris.
And yeah, have a good rest of the day.